Welcome to The Explainer. Sometimes the wildest stories aren't in books. They're hidden right inside the data. And today we're diving into a real head-scratcher. We're cracking open a technical report on one single super volatile stock. And trust me, it's a high-stakes puzzle. So, the company at the center of this mystery is called Oriental Rise Holdings. And what's so wild about it? Well, its data is telling two completely different, totally contradictory stories at the exact same time. It's a genuine mystery. And you and I, we're going to be the detectives on this case. All right, first things first, let's set the scene. Just take a look at these numbers. This stock has absolutely cratered, falling from a 52-week high of over $56 all the way down to just 16 cents. I mean, that's not a dip, right? That is a total near-complete collapse. This is the kind of chart that would make almost anyone run for the hills, but that's exactly where our puzzle really gets started. Because here's the twist. Despite that catastrophic drop, the very same report gives the stock a risk-to-reward ratio of 2.83. Now, what that means is that the data suggests the potential reward outweighs the risk. So how on earth can a stock that's fallen off a cliff like this still have a supposedly favorable risk profile? That is our first massive contradiction. So what's the deal here? Is this what they call a falling knife, something you should never, ever try to catch? Or is it more like a coiled spring, just building up tension for a huge rebound? To figure that out, we've got to dig into the evidence, piece by piece. Let's do it. Okay, so our first stop is trading volume. There has been a ton of activity in this stock, a huge amount of shares changing hands. But the big question is, what does all that churning actually mean? Is it a good sign, a sign of strength, or is it a really bad sign of weakness? Now, to make sense of the clues, we have to talk about a concept called a volume trap. And honestly, it's pretty much what it sounds like. You get this huge surge in trading volume, it looks super exciting, but the price just doesn't go up. It actually ends up trapping all the new buyers who jumped in thinking, this is it, it's going to take off. And this is where we hit our next major contradiction. Check this out. The on-balance volume indicator, which basically tracks money flowing into the stock, is screaming massive accumulation. It's saying big players are buying this thing up. But then the accumulation/distribution line, which looks at where the stock closes each day, is showing the complete opposite. It's pointing to significant selling pressure. It's literally like having two star witnesses on the stand, and each one is accusing the other. Who do you believe? In this number, man, it just paints a perfect picture of that trap theory. The stock is trading more than 61% below its volume-weighted average price. Let's break that down. It means the average person who bought this stock recently is sitting on a huge loss. All that volume came pouring in, but the price went nowhere. The trap, it seems, might have already sprung on a lot of people. All right, so if the volume indicators are at war with each other, what about the tools that are supposed to measure momentum? Surely they can give us a clear signal, right? Well, turns out they can't agree either. It is a complete technical tug of war. I mean, just look at this. On one hand, you've got the MACD indicator. It's showing a tiny bit of improvement, kind of hinting that maybe, just maybe, the worst is over. But on the other hand, you have the TRIX indicator, which is built to ignore the small stuff, and it is flashing a clear bearish signal. It's saying, nope, the downward pressure is still on. So once again, the data is just completely split down the middle. And if you thought that was weird, it gets even stranger. The report points out that one indicator, the Williams %R, says the stock is oversold. Okay, so that means it's cheap, maybe due for a bounce. But at the exact same time, another indicator, the CCI, is signaling overbought conditions, meaning it's too expensive. So which is it? How can a stock be both too cheap and too expensive at the same time? It's incredibly rare, and it makes this puzzle even deeper. Okay, so let's recap. We've got all this conflicting evidence piling up. The logical question you have to ask is there any clear direction here at all? Is there any kind of underlying trend? Or is this just pure random chaos? Is anyone, the buyers or the sellers, actually in control of this thing? Well, the answer to that comes from an indicator called the ADX. Its whole job is to measure how strong a trend is. And the reading here, it's just 13.29. Now, to give you some context, anything below 20 is considered weak. A 13, that's basically non-existent. The analogy in the report is perfect. Think of it like a river with almost no current. There's just no real force pushing the price in any clear direction. But, and this is a big but,
Buried inside that weak trend is a really fascinating clue. This chart here, it breaks down the directional strength of the buyers versus the sellers. And what do you see? The buying pressure is more than double the selling pressure. So here's the key takeaway. Even though there's no strong overall trend, the buyers who are showing up, they're showing way more conviction than the sellers are. That's interesting.
Okay, so let's put all the pieces on the table. We've examined the evidence, we have a catastrophic price drop, but a surprisingly favorable risk profile. We've got volume indicators at war, we've got momentum signals in a total tug of war, and we have no real trend. But underneath it all, we see this pocket of strong buying pressure. It's time. Let's put these clues together and see what possible scenarios shake out. To do that, though, we need to know the key price levels. You can think of these as the battle lines drawn in the sand. For the bulls, the buyers, to take control, the price needs to break above that resistance line at 0.178. If it fails and starts to fall, the key support level to watch is down at 0.124. Seriously, what happens at these two levels is probably going to determine the whole outcome. So when you put all our evidence together, the report boils it down to three possible futures. Scenario 1. A bullish recovery. If that hidden buying pressure we saw finally takes over and shoves the price past resistance, we could see a pretty significant rebound. Scenario 2, consolidation. This is where the weak trend and all this conflicting signals just lead to a stalemate and the price just goes sideways for a while. And scenario 3, a bearish continuation. If the price tries to break that resistance and fails, well, the sellers could take back control and push it right down to that support level and the collapse continues. And there you have it, the complete puzzle. The signals are crossed, the indicators are all fighting with each other, and the potential outcomes couldn't be more different. Now, we're not here to give you financial advice, of course. Our goal was just to walk you through the evidence from this really fascinating report. So the final thought we want to leave you with is this. When you see a puzzle like this one, a situation that's just full of contradiction and chaos, what does that tell you about where the true risk and the true opportunity might actually be hiding?